Well, let's get started today. I hope everyone is doing well. I'll introduce myself. My name is Misty Garza. I am one of the financial advisors here in the Gessner office in Houston, Texas. And our seminar today is going to be geared around interest rates and how they impact the lump sum pension values, specifically for the ExxonMobil pension plan. A little information for you guys. I do have the chat box available. So if anybody does have any specific questions, please feel free to ask your question there in the chat box. And I will monitor that and answer those questions as I see them come up, or I might save some of them until the end if I know that there's some information coming. So let's get started today. So for those of you that are new to our firm, just give you a little bit of background on Bogart Wealth. Our mission statement is to help clients achieve financial peace of mind by preserving and maximizing intergenerational wealth. So we have a little over $2.8 billion in assets under advisement, with just shy of about 1,300 households. We are a registered investment advisor, which means that we're an independent fiduciary advisor working in your best interest. We custody all of our assets at Charles Schwab for your protection, and we're a fee-only wealth management firm. The only time we get compensated is when we are managing assets for us. We have a very broad team spread across all three of our offices. This is a quick little summary of all of our advisors here that are on our team, as well as all of our organizational and management partners as well. All of our customer service, financial planning is done in-house as well too. We manage all of our assets in-house here within our Virginia office as well. And this is our team of investment management. Again, I had mentioned we have three different offices. We have our McLean, Virginia office, which is our headquarters. We have our Houston office at Gessner, which is typically where I'm at most of the time. And then we also have our Woodlands office as well. So for those of you who have already worked with us, you know that planning is at the heart of what we do. And I think that that should really be where everybody starts with when you're choosing to make decisions, for instance, in regards to how do you take your lump sum pension. And so most people think that planning for retirement is just about the investment management piece of it, but everyone's situation is different. And so it's important for you to focus on your goals and manage those issues that are important to you. Your situation as far as making retirement decisions or investment decisions is going to be very different than maybe a coworker or your neighbor or another family member. And so it's important to make sure that the decisions that you make are based upon what's most important to you and your family. So what we do here at Bogart Wealth is we take people through their planning process. And so if you've never gone through something like that, I would encourage you to reach out to your advisor here at Bogart if you're working with one, or to myself, and we can specifically talk about what it is that you guys are working towards and how to make sure that you make the optimal decisions. So we have started to produce a number of educational webinars throughout the year. And so we invite you to join all of our future webinars as well. You should get those via email. You can also visit our website at bogartwealth.com, where we do have recorded versions of those webinars as well. We've also created a podcast, and so we have some different topical issues on the podcast as well. So we're trying to build that out. This is just a quick little list as far as some of the ones that are typically the ones that most people ask about, that we make sure that we cover throughout the year and get those updated for you as well. All right, so let's get started here on how do the discount rates affect your lump sum. Again, specifically, this is geared towards the ExxonMobil pension plan. This could relate to anybody here who is not working for ExxonMobil, depending on what their options are and how their company manages their pension. But this is going to give you a little bit of idea of what the interest rates do across the board and how they impact that. And specifically, we're going to be talking about the qualified pension part within ExxonMobil today. So for some of you that are on the call, you might have some of the non-qualified pieces, which is the APP, SPP, some of those versions. So we're going to specifically kind of gear towards some of the timelines and the dates and things of that nature on the qualified piece. But again, all of these discount rates and the interest rates do affect both of those pensions as well. So one of the first things that people ask about is, which discount rate applies to me? So for most people, they are under the general rule. There's two, there's the general rule, and there are a few people that we still see who are grandfathered. But under the general rule, the rate that is in effect on your benefit commencement date is the one that applies to you. So your benefit commencement date is always the first day of the month. Doesn't matter if that is a holiday. So for example, to get the second quarter discount rate, the absolute latest date your benefit commencement date can be is June 1st. So by July 1st, you're already in the third quarter. Now, there is the exception to that, which is the grandfather folks. There may or may not be some of those people in the room. And so we'll get back to what grandfathered means in a minute. But grandfathered is related to the Pension Protection Act of 2006 and how that changed a few of the rules as well. And the main reason we mention this is because there might be a few people that might talk to some coworkers and they're not really sure if there's a separate one that applies to them. So for the grandfathered individuals, they get to choose the first available benefit commencement date, which is on their day of retirement, or the interest rate on their benefit commencement date. And so what that means is, for example, a grandfathered individual could have their last day of employment on June 29th, which would mean their first day of retirement is June 30th. And so then they're able to choose the second or the third quarter interest rates. So again, the general rule is the one that applies to most individuals that we see, but there are a few people out there that does apply to. Okay, so I briefly just kind of mentioned the Pension Protection Act of 2006. It actually took effect in 2007, and the biggest, most important part of this is that it placed limits on companies who provide lump sums. For example, a pension must be 80% funded in order to offer a 100% lump sum option. Now, if their funding levels drop, their lump sum options can change. This has not ever happened to ExxonMobil, so we're not worried about it too much. Now, this does not pertain to some of the lump sum pension options that they did away with. So please don't get that confused with some of the 2575 options that they did away with. That was just more of administration piece of it. When we talk about the funding levels and what that impacts on the lump sum, it's far greater than just eliminating some of the different options that are there. So the Pension Protection Act also defines the discount rates to be used. And so that's what changed a lot here for people as far as going from corporate rates to treasury rates as well. So the other piece of this is that companies are now required to update their actuarial tables and which ones that they're using. So the tables have to be updated every 10 years. The last time the table was updated was in 2018. And so just because a new table comes out does not mean that the company has to use it. So they do have to update it every 10 years. But since the last update was done in 2018, they actually have until 2028 to update the next table. They can do it sooner than that, but they will at least have to do it by 2028 with those new mortality tables. There's a few other little changes that the Pension Protection Act changed, but didn't relate to the lump sum. So, okay, so really quickly, I'm just going to touch on who is grandfathered, just in case there are a few people here. So again, this is related to the Pension Protection Act that came in 2006, took effect in 2007. And so companies had 5 years to implement this. So they were allowed to either phase it in or do one fell swoop. So Exxon went with the one fell swoop. So by the end of 2012, what that meant to an individual is that you had to have been age 55 and had 15 years of service. So you had to have been born before 1958 and hired before 1998 with no breaks in service. So right now, an individual would have to be about 66 years old and about 26 years of service. So again, not that many people left. So for those individuals, it's pretty simple. They just use the 30-year treasury bond rate and the 2000 mortality tables rather than any kind of updated ones. So we're going to talk specifically more about the general rule for those individuals and how those rates are calculated, because the 30-year treasury bond rate is easily seen. Okay, so a couple of our slides for the grandfather, it just gives you a little bit of an idea of where interest rates are going in general. So this is a chart that shows 40 years of the 30-year Treasury bond. And everyone knows that we've been coming out of historic lows and interest rates have been going up. And so people think that they're going back to normal or maybe higher, but they're definitely not going back to the 1980s, despite the fact that we've had high inflation. And that's always a comparable that people look back and say, are we going back to what those rates were? So we are still very far off from where they were in the 80s. Okay, so again, here's the current discount rate for those grandfathered individuals. The biggest distinction is that for those grandfathered individuals, every day counts for that group. And so what they do is they take 95% of those 30-year Treasury rates, and then they round them to the nearest quarter percent. So for those rates are calculated looking back 2 quarters from your benefit commencement date, okay? All right, excuse me. So moving on to all others. For those that were under 50 or had 10 years or less of service on December 31st, 2007, these new rules are going to apply to you. So the new rules are based upon corporate bonds instead of government bonds. The rates are based on 3 points along the yield curve. And if you want to track them, they are published by the IRS. And here's their address. It can take a little while for the IRS to update them on their website, but the Treasury Department calculates these so we know what they are before they officially get posted by the IRS. Now, corporate bonds have higher yields than government bonds because they're riskier. And so those are segmented into 3 different pieces. They also use the IRS mortality table, and it's updated at least every 10 years. And a longer life is good because then that means that there are more annuity payments that would be coming to you that would then increase your lump sum. So this is what the rates have looked like ever since the IRS has been publishing them. The numbers only go back to 2013, but we are looking at 3 different segments for interest rates. Segment 1 is the shorter term rates, which is 6 months to 5 years. Excuse me, I have a little bit of a cough this morning. Segment 2 is 5.5 years to 20 years, and segment 3 is 20.5 years to 60 years. So as you can see, the shorter term rates are much more volatile when compared to the other 2. So when rates go up very quickly, like we have seen over the last couple of years, then they can get compressed, as you see here in this slide. Okay, so one of the biggest things to think about is only the last 2 months in the quarter are used in the calculation for the interest rates. So we track the daily rates for each segment and then kind of compare that to the market data that is published to get a little bit of a prediction. So we already have the 2nd and 3rd quarter rates, as you can see here. So keep in mind the rates in the first month of the quarter do not count, but give us an indication of where rates are headed. So this is the same data in a little bit of a different format. It's kind of hard to look at these numbers and decide just how big of an impact that is on you. So what we like to do is back calculate what we call the single equivalent rate. And so for those in the non-grandfathered category, it's difficult to easily see the overall impact when short-term rates are moving at different speeds. When you have those 3 different segments that are moving differently, then it can impact what that lump sum calculation would be. Now, again, keep in mind, this quarterly rates are only impacted for the lump sum part. If you're choosing to take the monthly annuity, not going to have an impact on the rates. But when they are calculating what the current rates are, and we are looking at those different segments to calculate that lump sum, that's where it does become very difficult to look at those different segments and to determine what the impact that has on you, especially at different ages, whether you retire at 55 or 60. Okay, so a little bit of a history on these rates. Even though they only go back to 2013, we kind of took the same method that we used to get our monthly projections and backcasted that all the way to 1984. So a couple of points is that you can see that the rates have moved up quite a bit from their lows around the pandemic time. But before the pandemic, rates were at the lowest it ever been in US history. And so they've clearly increased since 2022 and do look to be higher than the average we've had in the previous decade. We don't really know for sure what's caused this downward trend over the last several decades prior to the pandemic. And so we don't know if we are going to, continue back down. You can see in 2009, roughly, they spiked and then they started to go back down. So whether or not this is another pattern where they could be spiking and could be going back down, we don't know if they will achieve any new highs or new lows anytime soon. All right. So now that we've addressed the interest rates, the question really now is, how does this impact my lump sum? Now, one of the things to think about for those that are retiring is that when you retire, you do not have to elect your pension. So again, it's something that you would need to work with your advisor or work with us to determine, based upon what your situation is and what the current rates are, what makes the most sense. Okay. So these next few slides are going to be talking a little bit about kind of how to calculate what the interest rates are so that you can determine what the trend is as far as whether or not when you choose to retire, you should go ahead and elect your pension. So this just shows a very simplified example that illustrates very clearly the impact of age at retirement, life expectancy, and interest rates. It doesn't give you the exact amount of the lump sum, but it gets you within about 10% or about $10,000 for every million. So we're illustrating here a retiree at age 60. And so for a 60-year-old, the mortality tables have them living until age 84. So in this example, we have an annuity for someone paying out $74,000 a year. Now, we contrived that because we wanted to make the lump sum $1 million. So we put in the interest rate for each segment. Remember, segment 1 is first 5 years, segment 2 is 6 to 20, and then segment 3 is 20 plus. So using these interest rates, we can calculate what that discount factor is. And so basically the discount factor is how much do I need to invest today so that I can get that future cash flow using the current interest rates listed. So once we calculate all of that, we call that the single equivalent rate, or the IRR, which becomes 5.23. Now, so this is what happens if you're younger. So same discount rate, but their annuity is only 75% of what it was before, right? You're retiring and making your election 5 years prior to retiring. I think everybody's usually familiar with a little bit of that discount or the 25% haircut that most people end up referring to. So life expectancy is 1 year shorter, but you're actually getting more years of annual payments versus electing it at 60, right? So from 60, you'd get it from 60 to 84. If you elected at 55, you're getting it 55 to 83. So on the lump sum, you're getting a little bit of a smaller amount, but the haircut really doesn't become 25% because of the projection of more payments over your lifetime. Okay, it really equates to about 3%. So now you'll notice that a person retiring at age 55 will have more years in segment 3, right? Because they are younger, so they're going to be getting their payments for longer. And so because of that, that means that segment 3 interest rates are going to make their lump sum pension definitely more sensitive. Okay, and so those longer term rates, as those move, that will definitely have a bigger impact on those younger individuals. Now, again, this is just kind of a simplified example. So we just kind of want to give you an illustration of how this works. So, okay. So one of the things to think about is how big an impact do interest rate changes have on the lump sum. So let's assume someone is age 60, retiring in the third quarter. Okay, so the single equivalent rate here is listed at 5.23. Now, typically what we will say is that for every 1% change in the interest rate, it's typically about a 10% change, either decreasing or increasing based upon the interest rate. So 1% higher interest rate is typically a 10% drop in your lump sum. and a 1% drop in the interest rate typically increases your pension about 10%. So this just kind of shows you the impact of that. The previous slide is we just kind of increased the interest rates. And so it showed that the $1 million pension dropped to about $12,000 less here, just by going from a 5.36% internal rate of return to a 5.54. Again, it's very easily done, but for some people, the question is the value of waiting. And so this is where we just need to kind of evaluate where the interest rates are and what is the projection to see where are we looking, forecasting where those rates are, and maybe which quarter would be a better quarter to either retire if you do have that ability to determine when you want to step aside, or if you haven't made your pension election, when to make it based upon the current market. Okay, so one of the questions is when would one consider delaying taking the pension? So again, one misconception is that people think that when they retire, they have to elect their pension. And so it's simply not true. You can delay your pension. Now, again, this is for the qualified part. Anybody who has the non-qualified pensions, APP, SPPs, then they still will have that automatic payout there as well too. So everybody's situation is different, and depending on whether or not you're taking the lump sum or the annuity or a combination of both, you should talk to your advisor to determine which one is the best option. If you are taking a combination of both, you do not get to elect the annuity part and delay the lump sum part. The decision when you choose to take it is going to be across the board of everything that you are taking. So if you don't need the money right away, or are retiring before 60, or expecting interest rates to fall, it might be something to talk to your advisor about. Okay, so one of the things about the timing and preparing for retirement are the decisions that need to be made. So this is a retirement roadmap that we put together for our clients to kind of walk them through some of the different dates. I'm going to move forward to a different one that gives you a little bit more detail on specific dates as far as when to make your elections. Okay. So if you're looking to retire on December 1st, 2024 as your benefit commencement date. So your retirement date would be the end of November, typically 90 to 120 days out. You can inform your supervisor of key dates, what your last day on the payroll is, your first day of retirement. And then if you are going to elect your pension, then you can do your intent to retire package end of August, around the September timeframe, to be able to get that done in time. You want to review everything. There are notarizations that have to be done. There's the non-qualified pension election form as well that is in there, that you do need to make those elections, even if you are not making your qualified pension election. Of course, you do want to make your medical plan payments as well. You want to make sure that you get your pension paperwork turned in 35 days prior to that benefit commencement date. And really that is simply because you will not miss out on the payment. But if you want to get the payment on your benefit commencement date of December 1st, they do want those in 35 days prior to that. If not, they only cut the checks on the first of the month. So if you miss that cutoff and you don't get it in within that 35-day period where they can review them, then you will get your check at the next first of the month as well. Now, again, you can definitely still make sure all your medical elections and all of your payments are done there as well. A little bit prior to that, you will receive a new medical card in the mail. So we do tell people that if you do have some different medical things that you have going on, or doctor's appointments, you will get a new retiree card. So that if you flip over and you have and you just make your medical elections and you go to the doctor the next day, it will be on a different plan. So just try to make sure you kind of coordinate some of those things. One of the things to kind of think about is when you're planning your retirement and reviewing all of these strategies is to make sure you do have a plan. If you don't have one, get one. Work with somebody to just make sure that you're thinking of everything, all of the big pictures, options, that you have. And if you don't have a plan, we'd love to help you create one and guide you through that decision-making process. It's important to create a budget. I find that is one of the things that people really need to know what their cash flow is. And some people are really good. They already know what that is. And then other people, we work through what their expenses are for retirement, because that helps you figure out when do you need to elect your pension, which pension option is best for you based upon what your needs are there. It's also important to know what your long-term risk profile is. And again, that can help you determine which one of the pension options is best for you too. Some of the things to kind of think about when you are looking for and selecting an advisor is finding one that is going to meet the needs of what you're specifically looking at doing. All different advisors provide different levels of service. And so finding somebody who is compatible with the relationship that you're looking for, they know your retirement plan, they know the IRS rules, that will work with all of the things that you're doing. They've navigated multiple business cycles. They're very open to discussing different strategies for you. All of our advisors here are certified financial planners. And so that's always kind of nice to make sure that we're not, again, just focusing on one piece of it. It means that it is more of a fiduciary capacity in looking at all the different areas for financial planning. We offer our one-on-one financial strategy sessions here, like I've alluded to throughout our webinar today. So we are more than happy to visit with someone one-on-one to go over what they're looking for and help them through that retirement process. So again, you can visit our website and contact us toll-free, online, give us a call, send us an email. We are more than happy to help you. And so that is going to be the conclusion of our seminar today. So I hope that everyone maybe kind of got a little bit of a feel for what the interest rates are doing and how they might impact you. I will look at the chat box and see if there are any questions that are coming through here and give that a moment. Again, I think one of the keys when it comes to the interest rates is deciding what works best for you and your family as the interest rates are moving, and understanding working longer, how does that impact the pension based upon what the rates are doing, what your years of service, your pay does as well, because all of those things are factors into your pension. Interest rates are just one of the factors that changes your lump sum pension value. It's probably one of the greatest factors, but there are a few other things as people are deciding when is the best option to retire. And sometimes people mentally are ready to retire. Other times it is a matter of just making sure you've achieved your goals so that financially you can retire. And just kind of talking through the market and your risk tolerance and making the right decisions. You only retire once, hopefully. So we want to make sure that as you are making these decisions that are typically irrevocable, as far as, making that pension election and deciding to retire, that you've thought about all of the different pitfalls and made sure that you felt comfortable and confident in making that decision. So I will leave it at that. And I don't see any questions coming through, so I don't know if there is anything there. But again, I want to thank everybody for joining me today. And if there's anything that we can do for you, I do see a question coming through. So let me look at that one really quickly. Okay. Let me go through some of them came through here on a different chat box. So one of the questions was the life expectancy, 84 for 60 plus year olds and 83 for 60-year-olds, 1 year shorter. So the mortality tables for a 55-year-old has it at 83. For whatever reason, when they look at calculating when somebody retires or a little bit earlier, it does shorten their life expectancy by a year versus working a little bit longer. So just that year short, that is correct as far as how they assume that. Now, again, they can't update the mortality tables there as well. Let's see. One of the other questions was interest rates have any impact on the annuity Again, the answer is no, it does not have an impact on the annuity. Now, one of the things that does have an impact on the annuity is that if you choose to work past the age of 60, depending on your years of service and how long you've been there, what your income is, that can change your annuity to where, maybe working a little bit longer after the age of 60 doesn't really change your monthly payments. For some people, maybe who started a little bit later at ExxonMobil, maybe working past 60 is not detrimental to them. It actually does add to their overall annuity. So that's a little bit of a caveat there for a few people. Let's see, one of the questions was, one of the questions mentioned, A-Light has said if you're deferring benefits and taking no money at retirement date, they tell you there's nothing you have to do paperwork-wise. That is correct in the sense that if all you have is the qualified pension part, if you don't have any of the APP, SPP portion, which again is what we call the non-qualified pension, you do have some paperwork that is involved to make sure that you make those elections. Previously, they used to default before A-Light took over. If you made no elections and you were choosing to defer your qualified, they would just default your non-qualified pensions via payroll. And I've had a few people have that question from A-Light. A-Light's like, no, you don't need to do any paperwork. And then they've gone back when they didn't get their pension, and A-Light says, yes, you have some paperwork to do. So for those individuals, if there is paperwork for the non-qualified part, but if you only have the traditional qualified pension, you do not have to do anything, but you still need to do your intent to retire because you still need to get all of your medical benefits, and you still need to make sure that they have all of that in process there. But otherwise, you're not going to need to turn any of that in. So if they do send you the qualified pension packet, which they will kind of once they put that through, then you just don't turn it in. And that pension paperwork is not good forever, so that when you choose to elect your pension, then you will have to call back and request new paperwork there. Typically, the pension paperwork is good for about 90 days. So that's why we don't want people to get it too early, because then you just don't know what you're going to be able to do there. So, yeah, so it does seem a little weird that you could retire and not have to do anything. But like I said, make sure you get your medical set up. We will do the copy of the presentation. Again, somebody asked, did I interpret correctly that after 60 your lump sum starts to go down, likely because of mortality? Yes. And again, the reason being is because when you think about how they're calculating your lump sum, they're calculating it based on the annual payments for your pension, right? And so if you are only going to live until 83, or even if they change the mortality tables and it goes to 85 or whatever it might go to, if you elect it from 60 versus 62 or 63, you're going to have less payments if you elect it later than 60. So most people, if they retire prior to 60 and we're watching the interest rates and they want to wait, if you've already retired, there's typically no reason to wait until after age 60 if you have not made that, because there's no more discount on it at all. And so those are the things we can kind of talk about, again, specifically on your situation and what you're looking at doing and what your risk tolerance is. I think a lot of times by electing the pension is right now mostly determined by what's going on with the interest rates and what you plan to do with the money if you were to take it now from a stock market standpoint as far as investing that money. Again, somebody asked about the life expectancy. Yes, it's just a little bit older if you take it at 60 versus 55. The lump sum, somebody asked how you get the lump sum. So they actually send you a paper check. It's the only way it has to happen. I know that seems crazy for people to sometimes maybe get a 7-figure check sent to them in the mail. It does come regular mail. And it can only come to you. So it cannot be sent to anybody else or a third party. The lump sum will not be made payable to you. So one of the things is that when you get your retirement paperwork and you choose those payments, we help our clients fill those out. And so that check is typically made to whoever the custodian is. So if it's going, you typically are rolling it over into your IRA, so it's not a taxable event. And so it's made to that custodian, but it comes to you. It cannot be cashed, again, because it's not made payable to you, it's made payable to that custodian. So once you get that check, you then forward it on to whoever it is that you're using to work with that. Our clients we'll provide them with a UPS envelope to overnight it to us, or they'll drop it off at one of our offices as well. Now that is different than the if you have any non-qualified, the APP and the SPPs, those do get done via payroll. So if you have any of those pieces, they will just do those as payroll. So they'll go straight to your direct deposit that you have on file. The Voya as well. So if you choose to roll over your Voya account when you retire, you don't have a time frame to have to make any decisions on that. But when you choose to roll over your Voya, same thing. They will cut a check for any of the non-ExxonMobil pieces that you have. So they'll cash that out, send a check. Now that check doesn't have to come directly to you. It can come actually to the financial institution, and they do still have the option that if you wanted to have a little bit more of a tracking express mail on the Voya piece, they will give you a little bit of extra comfort on that of sending that to you. But lump sum is directly to you. Timing wise, when you choose your benefit commencement date, so the first of the month, typically a lot of people will end up getting their check on the first of the month. So if your benefit commencement date is December 1st, typically they start to arrive in your mailbox around the 1st. So they get cut a couple of days prior to that. But I always tell people, give it about a week or so, just because the mail system, sometimes depending on where you live, and weather, things of that nature can kind of slow down that process there. So typically within those first 7 days, I would ask people that once they have filled out all of their pension paperwork and turned everything in to A-Lite, so A-Lite will handle all of the medical as well as all of the pension. It's just give them a call and make sure that all of your stuff is in good working order, that there's nothing wrong. I know people have had a little bit of some issues with some of the transitions with A-Lite. So you just want to make sure that if you're one that is able to just do everything electronically and just kind of print everything out and then upload it into the portal, just make sure that it all looks good. Or if you end up having to get some spousal signatures, and we end up kind of overnighting that, we'll overnight that to A-Lite for our clients as well. Just make sure that they got it and everything looks good, so that you are not turning it in and then hoping that your check comes on the 1st and it doesn't come, only to find out that you missed a signature or missed something that was there. So just something as kind of a little thing to just make sure that you're not going to be surprised by anything else there. Okay, so I think that was all of the questions. Again, we will post this on our website as well in a couple of days. It will be there. And then I will, if you send me an email, then I will try to get a copy of the presentation out to you as well. And I don't see any more questions, so I'm going to go ahead and again, thank you guys for joining the webinar today. Again, we're more than happy to talk about your specific situation and how the pension impacts the decisions that you guys need to make. I hope everybody has a wonderful day. Thank you.